Holding static cash is a mathematical guarantee of losing wealth. The invisible force of inflation constantly erodes your purchasing power. This chart shows how inflation destroys money over time. Using the rule of 72, a steady 4% inflation rate will slice your purchasing power exactly in half in just 18 years. The mathematical counterattack to this decay goes back to 1494. It was published by mathematician Luca Pacioli, who first introduced the rule of 72. To survive that mathematical certainty, you can't just leave your savings in a shoebox. You have to engineer an opposing force of exponential financial growth. This graph charts an exponential growth curve. If you take the number 72 and divide it by your expected annual rate of return, you find your timeline. An 8% return doubles your initial investment in 9 years. The natural human urge here is to hunt down the highest possible interest rate to make that curve accelerate as fast as you can. But high-yield assets don't move in straight lines. They experience violent, unpredictable upward and downward swings. If an emergency forces you to withdraw your funds during one of those deep market drops, the compounding cycle is permanently destroyed. This is the central paradox of investing. How do you capture the exponential growth of the rule of 72 without getting wiped out by the gravity of market volatility? Stocks, bonds, and cash function as specific engineering tools, each designed with a unique risk-to-reward ratio. Stocks are your heavy hitters. They offer the highest historical returns for your portfolio, but they carry the highest short-term risk of dramatic loss. Bonds act as your stabilizing tools. When you buy a bond, you act as a lender, consciously trading away high growth potential for a lower, steadier return. Relying entirely on a single stock or a single corporate bond is dangerous. It exposes your entire portfolio to a single, catastrophic point of failure if that specific company suddenly goes under. Individual assets alone cannot solve the volatility trap. You need a macro-level mechanism to combine and balance their distinct properties. Mutual funds and exchange-traded funds pool money to buy thousands of assets, creating diversification that neutralizes individual company risk. In 1952, economist Harry Markowitz formalized how to blend these assets together. He developed modern portfolio theory, a framework that earned him a Nobel Prize. Markowitz made a deeply counterintuitive discovery. By mixing opposing volatile assets together, you can mathematically reduce the overall risk of the entire portfolio. This scatter plot forms the efficient frontier, an optimal curve representing the highest expected return for a defined risk level. Overlaid, stock and bond waves move in opposite directions. When stocks fall, bonds rise. This inverse movement creates a shock-absorbing effect for the portfolio. Precise asset allocation serves as an active mathematical strategy to optimize your risk-reward equation. Because every investor operates under different constraints, there is no single, universal, perfect portfolio sitting somewhere on the efficient frontier. Your exact location on that curve depends on your time horizon. A 25-year-old has the physical time to mathematically survive severe stock market crashes, while a 60-year-old approaching retirement cannot afford that drop. Then there is your risk tolerance. This is a purely psychological variable, measuring your mental ability to endure a temporary loss of original capital without panicking and selling at the absolute worst moment. A functional financial portfolio must be custom engineered to match both your specific countdown clock and your psychological threshold. This pie chart demonstrates a mechanical flaw that occurs over time. Because of the rule of 72, high-growth assets like stocks compound faster, aggressively expanding to engulf the chart and distorting your original safe risk profile. To fix this mathematical distortion and reset your risk level, you perform a periodic maintenance protocol known as rebalancing. This requires an emotionally counterintuitive action, deliberately cutting back on the highest performing winning assets and using those extracted proceeds to purchase more of your currently underperforming assets. This protocol mechanically forces you to buy low and sell high, executing optimal market moves without the need for prediction or human emotion. A strategy built on exponential compounding, the structural stability of ETFs, and the cold discipline of rebalancing treats long-term investing as a solved engineering problem.